Okay, ladies and gentlemen, look, as a follow-up to the recent Munro webinar, we thought it would be a good idea to put together a short Q&A session that you could listen to in your own time. Today I have Nick Griffin back on the Zoom call. Hi, Nick.
Hey, Steve, how are you?
Good, thank you. Thanks very much for coming on the call. I've got about half a dozen or so questions here for you, Nick, from our Munro clients following that webinar. So maybe if I start with the recent webinar, as I said, we did earlier this month. A lot has even played out since then. What comments can you make, first of all, on the COVID crisis and how you're seeing this? And then second, how are you seeing markets right now?
Yeah, thanks, Steve. So as we said on the call, we said the situation was fairly fluid. We also said on the call that we wanted to progress the fund back to fully invested at some point. And I think, if anything, in the last month, we've moved quicker to that point. So as we look today, the fund is much, much closer to fully invested. And there are a number of reasons why we've gone a bit quicker there. The first one's around the COVID crisis. Is obviously the curves continue to flatten, and it's fairly clear now that we're moving into a market reopening phase. You can even see, I use the analogy about the football. When would the football start? Well, it looks like sports trying to start up in the second half, and so the bridge that we need to build to get to the other side, there's a bit more clarity about how big that bridge needs to be. Does that mean we stay open? That's another question, but it's a question for sort of close to the second half of this year. Secondly, on markets, I think the big change for us really was not long after the webinar, the Fed basically moved to support IG credit markets, the investment grade credit markets, and also support high yield credit markets. And this was a fairly dramatic move they did sort of just pre and post Easter. And what that does is it does take some of the solvency issues we talked about off the table. Yes, there will still be companies that go insolvent, but a lot more are going to get access to credit that otherwise wouldn't have. And on top of that, the really good grade, the good issuers or the investment grade creditors get credit even cheaper than they otherwise would have pre the crisis. And so ultimately, that move definitely made us a bit more positive. And so most of the exposure we've added to the fund, we added around that Fed move, both pre and post Easter.
So, Nick, the US has been hit the hardest with the health crisis, yet the US market has performed the strongest since the low on March 23. Could you talk about the overall level of the US market that seems to be out of sync with the overall economy?
Yeah, look, it's a good observation, and it's one that we were definitely looking at very early on as well. And I think this comes back to something that we say quite a lot when our roadshows is that the S&P 500 is not the economy. The equity market is not the economy. Now, yes, it should move in roughly the same way, but ultimately, if you look at this particular crisis, this crisis is very much affecting small and medium-sized businesses with small bad balance sheets that can't really get them through this crisis. Yet if you look at the S&P 500, it's full of companies that have great balance sheets that can get them through this crisis quite easily. Secondly, those Fed moves I talked about, investment grade credit, will really support those companies that can access credit markets. And again, that's the S&P 500, not the rest of the economy to a certain extent. And the last thing I'd say is just look, the S&P 500 looks completely different this time than it did last time. And so if I look at the top 20 companies in the S&P today, there's only one oil company whereas ExxonMobil was the biggest company in the world back in 2008. And there's only 4 retailers, if you think about it. And those retailers are Costco, Walmart, Home Depot, and Amazon. And so all of those companies, if you look at that top 20, they're potentially net better off because of this crisis. And the market is quite correctly working that out quite quickly. And so the other way to see this quite quickly is if you look at the NASDAQ in the US, it's now down less than 5% for the year. Yet the Russell 2000, the US, i.e. the smaller 2000 companies, is still down 30%. And so that's the market just being quite efficient, trying to work out who are the winners here in the long run, whose earnings will grow over time, and then adjusting that accordingly. And that's something we talked about the webinar, and it's something that started to happen quite quickly, partly because of those Fed moves and partly just because the composition of the index is different to what you think. The last way I'd talk about this is interestingly, you see a company like Amazon that's moved to its all-time high just in the last week. And intuitively, that actually makes sense here. And so from that point of view, it's just the market in the US being efficient as to who are the winners and losers going to be out of COVID-19 and not necessarily looking at the overall economy.
So Nick, moving on to your portfolio, let's talk about the Munro Partners area of interest, and in particular your top three being e-commerce, digital payments, and digital enterprise. These areas have been very strong during the COVID-19 crisis. Do they continue to win in a post-COVID world?
Yeah, so look, from our point of view, look, we've showed a number of slides over the journey where we talk about things called S-curves, S-curves of adoption, whether that's in e-commerce or digital payments or cloud computing, etc. We've shown these S-curves a lot. And the interesting thing about the COVID situation is what it means is that S-curve of adoption probably accelerates post-COVID-19. And so if you think about e-commerce as an example, your propensity to use e-commerce is probably more so in a post-COVID world. And so when you look at, again, a company like Amazon that I mentioned earlier, while its overall aggregate demand is going to be lower post-COVID-19 because of the recession, the shift to e-commerce will accelerate. And so Amazon may be net better off out of this. And that's why the company's gone to an all-time high. We'd say it's the same with cloud computing, and we'd say it's the same with digital payments. Now, some of these areas will take hits this year, but we'd argue on a 3 to 5 year view, these shifts are going to accelerate. So these companies will be better off on the 3 to 5 year view. So their earnings will grow and hence their share prices will grow. And so from that point of view, we're still very much focused on these areas. And if anything, we're doubling down on them as we lift exposure in the funds over the last month.
Okay, so Nick, do you think that creates any concerns, I guess, from an antitrust or regulatory standpoint down the track for these companies that you just mentioned?
Yeah, look, it's a really good question, and it's definitely the one thing we are concerned about. Ultimately, when the dust settles from COVID-19, it'll become clear to authorities that ultimately this massively favours, those four big retailers, and small to medium-sized businesses will suffer. And I don't think any of us really want a world where there's only a few big retailers in the world. And so from that point of view, we think it will come to the fore at some point. But we don't think it's today. We think it'd be madness to crack down on these companies regulatory at this point in time. Amazon's in the process of hiring 175,000 more people at the moment. And so we think it's something for definitely down the track. On top of that, we'd also flag that Bernie Sanders is no longer the Democratic nominee. And so it's much less of an issue, going to become an election issue in November. So yes, the big companies unfortunately get bigger because of this crisis. Our fund has invested that way. That does create regulatory concerns down the track, but we don't think it's something in the medium term.
Yeah, okay. So just moving along, what other areas are you looking at right now? What's looking interesting for Munro right now?
Yeah, so outside of those big sort of digital shifts that we've been talking about for years that we now think accelerate, other areas for us would include semiconductors. We do think that ultimately semiconductors are the weapons manufacturer in the war here. Both in the war against the virus as we move into track and trace with the cloud and the ability to trace people around the world. Also, when we look at things like 5G will continue to get rolled out here quite aggressively, as will cloud computing will get rolled out quite aggressively. And semiconductors are really the heart of that. So they're a good cyclical and structural sector today. Second area for us is definitely healthcare. Look, we've been focused on diagnostics for a long time. If anything, we're going to increase that now. Clearly testing is the solution to getting the economy back on track. And so here we look at our companies like Thermo Fisher, but we're also looking at companies that do temperature control, etc. And so that healthcare area is another big area for us today, and one that will probably get bigger.
Okay, so Nick, during the webinar, you spoke about currency hedging in the fund. Can you provide an update on where you're at today with hedging?
Yeah, so in the absolute return products, we do have the ability to manage the currency for you. And so like a lot of people have done, we've used the weakness in the Australian dollar to increase our hedging. And so the fund is currently 60% hedged back to $80 and roughly 40% US dollars today. And so from that point of view, we do see room for the currency to continue to rally even all the way to 70 cents and still be in the downtrend that it was previously. And so this is really an opportunistic move, mainly to protect capital or protect those gains and to not lose money as the currency bounces back up here.
Okay, so post the webinar, we had a couple of questions around liquidity. Now today, Munro Partners is managing approximately 1.5 billion in assets. This is predominantly in the long-short strategy. can you talk about the importance of liquidity in a long short absolute return offering, and how you go about managing that?
Yeah, so it's important to recognise, look, we just spent a bit of Q&A talking about how things look better and the fund is more invested than it was. And we're very happy with the areas that we're investing in. But it's important to remember that, that ultimately, we didn't see this virus coming. And ultimately, all of the performance that we created in the first quarter came because of our ability to be liquid. Now, as we progress through this year, I mean, it's important to say that none of us really know how this opening up is going to work out. And I'm sure a number of people listening have their reservations. And so from our point of view, it's important that the fund remains liquid. It's important that it has the ability, because it is an absolute return fund. It has high watermarks. Its job is to deliver superior absolute returns through the cycle. And there, as we've said in the past, we target double digit, and we did that for the last cycle. And so from our point of view, it's important that it remains liquid, because should things change, you can be confident that we will change. We measure that liquidity by the rule that 80% of the fund has to be able to be sold within 10 days at 30% of average daily volume. That's how we measure it. And so ultimately, we'll continue to track that number. And if the fund does get bigger, at some point, we may say that this is affecting our liquidity. And what's more important to us is our ability to be liquid. Because we do get paid on the performance of this fund, not the amount of money that it runs. And so what's important to us is that we can continue to perform. And so investors need to be confident that we are watching that liquidity very closely, and it is really the key to our ability to deliver those absolute returns through the cycle.
Okay, look, and just maybe a way of wrapping up the call, and finally, do you have any last words in relation to the Munro funds that you'd like to make?
Yeah, so the last thing I'd say is, look, from our point of view, we are travelling across that bridge, across the valley at the moment that I showed in the webinar. And look, we are further across the bridge than we were when we last spoke. From our point of view, when you get to the other side, COVID-19 is literally just another structural change in the world that we need to look at, and then find who the beneficiaries are and invest to drive returns for our clients. And so from our point of view, we know how the world will change on the back of COVID-19, and we know structurally who the winners will be. And so our job as your global growth manager is to find those areas of interest, which we talked a little bit about today, find the companies that win and invest to benefit. And then ultimately we provide that in two products. One's our long-only product that's fully invested all the time. And the other one is our absolute return product, which is much more invested today than it was when we spoke previously, but ultimately will retain the liquidity to deal with whatever comes next.
Okay, well, great. Thanks very much, Nick, for sharing that information with us all. And thank you, everyone, for taking the time to listen to the Q&A session. We'll continue to bring you these updates as there is relevant information to be shared. Look, until then, please stay well, and we look forward to talking with you again soon. Thank you.